Hi there, I'm Andrew Macken and welcome to this week's edition of Video Insight. Well, over the past few weeks, we at Montgomery have had the privilege to meet with many of our clients all over the country as part of our national roadshow. As part of the presentations that we delivered, we were able to discuss our two new global offerings, the Montgomery Global Fund and Montaka. One of the key messages we discussed as part of those presentations was this idea that we are able to position our global portfolios to reflect the observations that we're making with respect to what's happening in the world. And I just wanted to flesh that idea out with you a little bit today. So take a look at the chart shown on the screen now. You can see there's a driver tree across the top. Let me start there. Basically, we discussed this idea that you can think about the high-level economic drivers of your returns whenever you buy a stock. So very quickly, if you buy a stock, you think about your return is the dividends you receive plus a change in your share price, and you can actually think about what drives the change in share price over time. What's your earnings, a company's earnings, as well as changes in valuation multiples, such as a PE ratio. Earnings, you can think about those in terms of underlying revenues and profit margins. Revenues, you can even think about in terms of aggregate economic growth or GDP multiplied by that company's share of GDP. And then you can even think about GDP in terms of its underlying drivers, which includes things like demographics, productivity, capital, and also external shocks such as changes in the oil price. Now, one of the ideas that we discussed on our roadshow was this idea that we as a global fund manager, we make observations with respect to what's affecting each of these drivers and in turn affecting your returns as the holder of the underlying equities. So on the chart shown, you can see the grey boxes, and these illustrate some of the observations that we're making with respect to what's happening in the world. So, for instance, you can see the middle one talks about corporate profit margins. Well, we know that corporate profit margins in the US are at all-time highs, and yet we know that wages, which is obviously a key driver of corporate profit margins, are actually starting to accelerate in the United States, which should ultimately bring those corporate profit margins down. We discussed a couple of ideas that we actually have in our global portfolios. In our long portfolios, we own a business called Insperity, which is what's known as a professional employer organisation. So Insperity will actually co-employ the staff of small to medium-sized businesses and take care of things like payroll and compliance and health insurance and stuff like that, in return for receiving a percentage of those employees' wages. So you can see that as wages inflate, that actually equates to growing revenues for Insperity. So Insperity is uniquely positioned to actually take advantage of wage inflation. In Montaka's portfolio, remember Montaka can take advantage of businesses that are in decline. So in Montaka's short portfolio, we are short a business called Regis, which takes advantage of this same theme, wage inflation, but from the short side. So what Regis is a network of around 9,000 budget hairdressing salons across the United States. You know, we're talking $14 haircuts here, razor-thin margins, and the largest component of the cost structure is wages. And so naturally, as wages inflate, it very quickly impairs the profit margins of these salons and basically wipes out the profit pretty quickly. And Montaka can take advantage of both Insperity in the long portfolio and Regis in the short portfolio. And then thinking about the fourth grey bar, talking about winners and losers within an economy, you know, our global long portfolios own a fantastic business called Take-Two Interactive, which is the owner of one of the most popular gaming franchises of all time called Grand Theft Auto. And we know that gaming is in structural growth, and the ability to monetize games with in-store sources of revenue is growing structurally. That's a really nice pocket of the economy that we can take advantage of. And then the flip side, Montaka's short portfolio can take advantage of parts of the economy that are deteriorating. The example we've used there is Ensco, which is a deep water oil driller. Now, naturally, Ensco's revenues are basically at the mercy of the capital budgets of the major oil companies, and we know that those have been slashed and are only being cut further, which is really negative for Ensco. And Montaka can take advantage of that. So look, I'll leave it there. I just wanted to give you, or leave you with this idea that, you know, we are by no means a macro fund manager or anything like that. We start our research process always at the bottom and work our way up. We are fundamentally driven, but as a fund manager that invests in global equities, what we explicitly do is make observations with respect to many of these global economic drivers that affect your returns, and we make sure that our global portfolios are positioned to take advantage of these observations. So with respect to our two new global offerings, the Montgomery Global Fund, you can think of those as holding just the blue boxes in the chart shown, and then Montaka holds both the blue boxes, which is the long portfolio, as well as the red boxes, which is the short portfolio. Okay, I'll leave it there, and as always, if you've got any feedback, please don't hesitate to send it through.